When you're applying perpetuity from year 5, all of you are getting value 1 year back. Okay, let's start our discussion on recent past exam question, Joshua Company, on merger acquisition valuation. So we are mainly discussing the practical part. So the first question is calculate post-acquisition weighted average cost of capital. So in this question, we have to calculate post-acquisition cost of capital. What will be the cost of capital after acquisition? Okay, not a difficult task. Second requirement is estimate additional value to shareholder from Joshua Company proposed acquisition of Fraser Company. So here they want us to calculate that what extra value, additional value, the premium to shareholder from Joshua to acquisition of Fraser. Okay, we will see 11 marks for that. Then third, compare shareholder wealth before and after acquisition. So before and after wealth, shareholder wealth acquisition. Again, 6 marks for that. Advise board of any concern either company shareholder may have with acquisition discussion validity. So board concern you have to discuss the credibility of CEO alternative suggestion to use share buyback as a takeover defense and advise whether or not is a feasible strategy for Joshua Company. So last part is a purely theoretical part where you have to discuss benefit of share takeover instead of going for acquisition. So we will see. Let's first discuss the practical part first. Now let's understand about Joshua Company, what's going on with this company. Joshua Company is a listed leading fashion retailer with store based in the flagship retail center national worldwide. Joshua is a listed leading fashion retailer whose store based flag retail center nationwide. For many years, Joshua Company had been highly popular, but its financial performance has suffered recently due to problem associated with its online operation. The Joshua Company has been highly popular, but its financial performance has suffered recently due to problem associated with its online operation. These problems are causing concern for the company's institutional shareholders. Okay, so some issue is going on with the company. Online rivals have emerged in the recent year and are quickly reducing Joshua Company market share. These companies have also successfully diversified into other areas such as household furnishing. Once they have established well-known brand, Joshua Company recently attempted to acquire one of these online rival Fraser Company, but neither company shareholder approved the deals on the ground that it was unlikely to create value. Okay, so they are thinking that this acquisition will not create value. Shareholder are of the opinion that this acquisition will not be fruitful. Obviously, that's why they have made an entire question for us. Following a series of profit warning. Do you understand the meaning of profit warning, all of you? What is the meaning of profit warning?
There has been profit decline, or the profit was not enough, or that is, it's going to be declining in the future, something like that.
Correctly. So profit with warning means company is expecting that in the future there will not be a profit as expected, or there may be losses also. So profit warning is a bad news. Following a series of profit warning, there has been ongoing media speculation that Joshua company is attracting takeover interest. So Joshua company is attracting takeover interest. That is also going on. There has been no approach made so far, but Joshua company director are concerned about. There has been no approach made so far, but Joshua company director are concerned about implication for their future in the company. Joshua company chairman would likely to discuss the defense strategy in upcoming board meeting, particularly the suggestion that Joshua company could defend itself against takeover by improving its own takeover offer for a Fraser company. The rationale for this suggestion is that it would be much more difficult to acquire and enlarge Joshua company. In addition, this would also introduce a risk diversification benefit into Joshua company operation. So from all this part, we were able to understand that basically they are concerned about takeover. That's why there is a separate requirement where they want us to compare this takeover thing. So huge takeover risk is looming on Joshua company. And from that, Joshua company is looking at protection from it. Now here, from here, our practical part start. Joshua company funding option have been reiterated significantly since last year. Cash offer for Fraser company was rejected. Okay, so in the last year they have given a cash offer to the Fraser company and it got rejected. It no longer has a cash reserve required to fund another cash offer. So now they don't have even cash to give a cash offer. So obviously they are going to give share for share offer, and the shareholder are unlikely to agree to a right issue so soon after the last attempt, which also ended in failure. So even their own shareholder are not going to give them the further fund. Right issue has also failed, so they have no way to get money. In addition, Joshua gearing significantly exceed the industry average, and company is close to breaching one of its bank covenant. Everything is going bad for this company. They even cannot take loan from the market. Already they have exceeded their debt capacity. The CEO has therefore suggested a new offer is made for Fraser company based on a share for share exchange. Okay, still they are not losing the hope of acquiring the Fraser company. They want to acquire it. Is it that important? It is that beneficial for the company? We will see. The following information is available, including brief extract from both company most recent annual report. So most recent annual reports of both the companies are given to us. Market value of equity, Joshua company 102, Fraser 56, asset beta 0.85, 11.8, dividend 2.7, 3.2, ordinary share 40 and 10. Nice. So lot of data they have already given, asset beta and all these things, made our life easier. Cost of capital. So Joshua company post acquisition asset beta can be assumed to be weighted average of both companies pre acquisition asset beta. Okay, we will do that. Weighted in proportion to their market value of equity. Okay, cool. The board intend to maintain the company existing debt equity ratio of 30:70 based on market value, right? And expects the pre-tax credit spread on Joshua company debt to remain 4.1% above the risk-free rate if Fraser company. So 410 basis point, 4.1% above the risk-free Fraser company is acquired. Expect the pre-tax credit spread. So all this information is, I think, sufficient. We should not, we don't need to read further. At least we can solve for the first 6 marks. If you remember, they want us to calculate post acquisition weighted average cost of capital. So let's calculate. So basically, it's a part B. First part. So in exam, you can refer it as an appendix 1, 2, because in the report, you have to prepare the report in the exam. Na? So in the report format, in the Word, you will make the report format. In the Excel, you will do these calculation. So I can make heading calculation, or you can copy paste from the question itself, calculation of post acquisition cost of capital. So they want us to calculate post acquisition cost of capital. Now they have given asset beta. Data they have given us market value of equity. Joshua Company and Fraser Company. Both market value is given. Let's copy paste this information. Data is in $1 million. And then we have 56. Asset beta is also given 0.85118. 0.8511, sorry, 1.18. So this data is given to us. Now simply question says that post acquisition asset beta. Post acquisition asset beta is a weighted average. Weighted average. So no issue. We will do weighted average. This plus this 158. So 0.85 multiply market value of equity of Joshua divide 158. Right? Bracket close plus bracket open. 0.18
0.55, I got 0.55
and
plus
56.
I got total 0.97.
Let me complete. Then we will check. So
0.55 plus
point
0.97.
0.97 we are getting post acquisition asset beta. After post acquisition asset beta, we can calculate equity beta because you have to also upload the gearing. Asset beta they have given us simply, and for equity beta they are saying that the board intend to maintain company existing equity ratio of 30:70. So the ratio they want to maintain is still 30:70. So that is not an issue.
If there's no further debt, anyway we are exhausted.
Correct. So we already have exhausted ourselves, so they cannot change the debt structure. That's why they are maintaining the same debt. A reasonable point. Now, what was the formula for calculating beta equity?
PE by divided by like my whole thing. PE plus PE. Like the ungearing, no, that type.
Right.
Beta asset into P
So
plus B, P 1 minus T divided by BE, no? Kind of.
beta asset into bracket 1
Yeah.
plus debt upon equity. How much is the debt? That is 30. Bracket open, that is 30 divide 70. that is 30 by 70, right? Multiply it. You will multiply it with
Isn't it 100, sir? Isn't it 100? 30 is to 70 means 100, no? The total. VE plus VD. How is it 70?
yeah. VE plus VD will be 100.
Yes.
100 multiplying 1 minus t. How much is the tax rate?
18%.
So 18% is the tax rate. But this is not the formula, no? Uh, we don't add
Huh?
debt. We only take equity, na? Debt upon equity. The formula is only debt upon equity, na? What is the formula? Formula is, I think, unlevered beta multiply 1 plus
Divided by VE. It is
debt,
divided by
debt
multiply VE, V beta asset into VE plus VD into 1 minus tax divided by VE. Is the formula, no? If you highlight that, maybe I don't know what is applied.
check out.
The beta into 1 plus VE plus VD into, so the 1 minus T, and you have to divide it by VE. No, the whole thing.
Whole thing need to be divided by.
But where is the 1 plus come from? 1 is, it is straight away VE plus beta EA asset into VE plus VD into 1 minus T divided by VE. The other way around. But 1 plus, how did you get 1 plus, sir?
So in
VE
this,
is 100, so sir. VE is 70.
see, you can do this formula in various manner. One can be this also. Let me show you the formula. It's one of the same thing. If you take one common, or if you don't take one common, that is same thing, right?
So what is the final answer?
Huh? Yes.
1.31, no?
1.31, right? Understood. We can take one common also, no? Answer will be same. Now, if we round off this, 1.31 equity beta you will get, right? Once you got 1.31 equity beta, now you have to calculate cost of equity. For cost of equity, you will apply CAPM. So have they given us data for CAPM? check out. Let me know. Is the data for CAPM is given? Risk premium 8.1. Okay. 18% corporation tax, RF 3.7%. So there is data 3.7% plus bracket open 1.31 into 8.1%. So if we convert it in percentage, it's 14.3%. And in the question, they have given us KD, cost of debt, pre-tax cost of debt. That is also given that it is 3.7 plus 4.1. So 7.8% is the pre-tax cost of debt is given to us. Now, just calculate weighted average cost of capital back. 6 marks is done. So 70 to 30% capital structure equity debt is 70-30 equal to bracket open this multiply 0.7 bracket close plus bracket open this 7.8 multiply 1 minus tax rate, so 18%, 0.82 multiply weight of debt 0.30. So if we round off this, we can take it as 12%. So WACC will be 12%. Let me know if there's any doubt in the calculation of WACC to anyone, please.
So can you go back to cost of equity formula? Sir. So 6 marks.
Correct, Radhaji. Very good. 6 marks is yours. Cost of equity, we applied CAPM formula, na? RF plus RM minus RF risk premium is given multiplied with
Okay,
beta.
okay. Understood.
CAPM formula. Let me write down if anyone is confused. Now let's do the second part. Sir, what is second part? Calculation or estimation. They want us to estimation of additional value. So I hope you remember how do we calculate additional value. So formula for additional value is combined value of both firm minus individual value of Joshua and minus individual value of Joshua and Fresher. Right? Now, let's work for it. Let's calculate the combined value and all these things.
Step I did was finding the free cash flows.
Yeah. Let's calculate the cash flows first. For that, we need free cash flows. Let's see, read the information.
The
Post
next paragraph has about information.
post acquisition cash flows will have all the information. According to the finance director forecast, Joshua company will earn profit before interest and tax of 27.2 million the first year after acquisition, growing 5% per year of following 3 years. Very simple. So the data
Profit before interest and tax.
0, 1, 2, 3, 4. So cash flow for the 4 years we have to calculate. PBIT they have given for the first year, they are saying that PBIT is 27.2. And after that, there will be a 5% growth. 28.6, Control C, Control V. Making sense? Now,
Yeah.
5% growth in the following year. It is assumed that tax allowable depreciation will be equivalent to the amount of investment need to maintain existing operation. However, investment in asset of 2.7 will be required in the year 1. Then 2.13, 1% increase PBIT from year 2 to 4. It is expected the acquisition will create after tax synergy of 9.2 million per year in each of the first 4 years. From year 5 onward, the company free cash flow are expected to grow annually 3% variable. So terminal value is also there. Perpetuity value is also there. So two value, explicit period value you have to calculate separately, and the terminal period value you have to calculate separately. So there is a synergy of 9.2 per annum. There's a synergy of 9.2.
That's after tax.
And that is after
tax. So we have to minus tax in this.
Right.
The previous cash flows. And only we can add.
So let's do one thing. Let's right now not consider synergy. Synergy is annuity. It is coming every year. Let's consider synergy separately. So let's tax is 18%.
Yeah.
So put a negative sign. 0.18.
I'm getting 4.9, 5.14, 5.4, 5.67.
No, this calculation is obviously going to be right. Increase in asset investments. So there are some asset investments are also there. In free cash flow, these will be considered as a capital expenditure, my friend. 2.7, then 2.13. So
no. 2.13 is multiplied by the increase in PBIT. It's not exactly 2. Sorry, if you read it, no? Then 2.13 per $1 increase in PBIT. That is how it should be taken.
Correct. So minus 2.7, and this 2.
From there on, we have to.
Correct. So increase. So if we take this minus this
into 2.13.
Into 2.13. So am I doing right now? Correct. So 2.13. Let's put a negative sign. So correct. So just to make clean, let's round it off. Now we will get free cash flow. This is free cash flow without considering synergy. Don't worry, I remember that I have not considered synergy. I will take it separately. 19.6 and 22.6. Now, one interesting thing here, that this 2020 22.6 from the year 4, it says that from year 5 it will grow perpetuity. That is also given. You can see it says from year 5 onward, free cash flow expected to grow 3% foreseeable future. 3% foreseeable future. No worries.
Sir, I have a doubt here.
Discount rate.
Do we add the synergy, sir, and then apply the discount rate? I mean, because that's also added on, no, every year.
Yeah,
Should we not discount that? And also, do we not take it as a free cash flow?
No. For synergy, until and unless they have mentioned that synergy will continue in the foreseeable future, we generally do not take synergies. If you see in the question, they are saying that it is expected to create synergy per year in each of the first 4 years. So synergy will be only on the first 4 years. From year 5, synergy will be not there.
Okay.
When question specifically saying that synergy, although
I had that doubt, but I worked out both ways, so I was just looking. Okay, what you're saying is right. We should not take.
No, it's an interesting doubt, although very good doubt raised by Anuradha ji. So
For the first 4 years, don't we need to discount it? I was wondering. So then, after which, as you're saying,
understand. Another thing said the terminal value which you are going to take, for that the cash flow you will take 22.6 or including synergy cash flow. So here my assumption is, as per question, that synergy will not continue because it's only said first 4 years. But even though, don't worry, that is the beauty of our professional examination. If you have taken synergy and then performed discounting, perpetuity of formula, the dividend growth model, if you have applied on that cash flow, then also you will earn full mark. Just write down your assumption in such case. Now discount rate is 12%.
Yeah.
So let's calculate the present value. Present value of explicit period. Explicit period means given period. So we can use NPV formula now to calculate present value. Basically, NPV formula gives us present value. If we have not deducted this outflow, ultimately this formula basically gives us the present value now. So it's 63.6 million around, and from year 5 terminal value, if we want to calculate terminal value, that can we easily calculate. So how do we calculate terminal value? It says this cash flow, free cash flow, will grow. Growth rate is 3%, sorry, 1.03. Now divided by bracket this minus 3%. Now all these things, I don't want you get sir which formula you are applying and all these things, please. All these doubts should not be there. And this is terminal value at year 4. But we need terminal value at year 0. So you have to do what? You have to discount it. One divide 1 plus 12% power 4. This is the correct answer. Don't forget this, the necessary step which I have done here. Do check my calculations are right now. Let me know. When you're applying perpetuity from year 5, all of you are getting value 1 year back.
Sir, yeah. I lost my internet again and again. I'm having a problem. This terminal value, present value of explicit period, that is the present value of those free cash flows, total,
4 cash
after discounting.
These 4 cash flows present value, right?
You totaled it up and done it, or how did you do it? Individually, no?
I applied simply NPV formula.
Oh, okay. That's what I was wondering. You had it put the discount factor. Okay, so NPV will give you the okay,
present
because
value.
we have already minus the cash flow, everything. That's what you're saying.
NPV will give you present.
Can you see that formula? Sir, can I see that NPV formula? What you've done? Just highlight on that.
NPV will give you present. NPV will give you present value, my friend. If you have not minus the outflow, here we are not minusing the outflow. So ultimately, NPV, you can also use NPV for calculating present value. This formula can be used to calculate.
That's what. So you won't give the last amount. You won't give, no, plus something.
No.
It becomes present value.
Correct.
So,
yes.
So 63.58, can I just see that highlight? Please highlight it, sir. I want to see what you have done there.
Already
Exactly.
highlighted.
Oh, it says terminal value. You're not in that.
63.58 is the present value. For terminal value, I-22, I multiplied with growth 1.03, 1 plus growth rate, divide by 12% minus 3%.
Oh, I just want to see that, sir, because that's where I made a mistake. So we have to apply the formula, growth rate formula.
Right.
I just divided it by R. That is wrong, no? Growth rate.
Yeah, that is not the formula. Formula is cash flow plus growth rate divided
Isn't
by
it
K
annuity
minus
for perpetuity? Don't we just divide it by R?
But that is perpetuity without growth. Here we have with growth.
Okay. Yeah, that's where I made a mistake. Hold on, sir, for a minute. Okay, you send me the thing so that I will later on correct it. I don't want to waste your time.
Definitely.
Yeah, that is what I did mistake. That is, I did everything right, but divided by growth rate I did, which is not right. You'll have to find the formula, the growth product. You use the 3% as growth rate.
Right.
What was the growth rate you used? Yeah.
Growth rate 3%. 3%. It's given in the question, na? 3% foreseeable future. Right.
Okay.
Now we got the terminal value at year 0. Terminal value is also known. Let's calculate synergy. Now synergy will come in first 4 year.
Yeah, 9.2.
First 4 year only. I'm writing down this so it will.
9.2 in all. Yeah.
Now I want annuity factor. 12% 4 years annuity factor I need.
I'll give you.
Annuity factor. So you can simply apply
3.037. 3.037.
3.037. So what we can do, let me also show how can we solve on Excel to students. 1 minus bracket 1 plus your R is 12%, right?
Yeah.
R is 12%. Bracket close, power -4. Since you need 4 year annuity factor, power -4 divided by your R, that is 12%.
But this will be given in the thing, so why do we have to worry? 3.037 will be accessible. So
yeah. 1 second.
9 point into this,
so,
no? 9.2.
Using this formula you can calculate, or it will be given. Yes, no need to put all this effort if it is already given. If you want to work out like that is also 9.2. So 27.9. So value of combined firm, value of combined entity. What is the value of combined entity? Tell me fast, all of you. Which all figure should I add to calculate the value of combined entity?
The terminal value and the synergy.
Explicit period
and also
value.
the 4 cash flows. The 4 cash flows is the present value.
Yeah, present value, terminal value, and synergy. All these things calculation.
Yeah.
So 258. This will be our value of combined entity, but we need value of equity. This is a value of combined entity because you have calculated free cash flow. So it's total value. Remember, it's total value. It's a total value of combined entity, and we need. It's a total value of combined entity, and we need only value of equity. So how will you calculate value of equity? Can you tell me in this question?
Can we take the market value of both and then minus it before?
See, market value of equity and Joshua company and Fraser company before market value of equity is given. That is not given,
158.
but they have given us the percentage of 30 and 70%. It says 70% is equity value. So we will assume the same method on this 0.7. 70% we will assume equity value and 30% we will assume value of debt. In this total value of the firm, so understand all this. This is an important part here. It says the board intend to maintain company existing debt equity rate 37 based on the market value. So they are going to maintain the debt ratio of 30:70. So in the which is based on the market value. So total value. So they have given us 30:70. So accordingly, we can calculate a value of equity assuming that it is based on the market value. Generally, what I have taught you, when you take free cash flow to firm, you will get total value minus value of debt, value of equity. So 30% you need to minus here, or you can multiply directly 70% to calculate your value of
But
equity.
we have to find the added value, no?
Yeah, that we will come.
For that, I was saying, should we
Additional.
take the market value and then
See,
minus it?
if we talk about additional value, how will you calculate additional value? For additional value, you have to minus the individual value of equity, and that is given in the question. This is the total value of equity of new firm. What was the old value? That's why we have written here. 106 is the market value of equity minus 56. This is the additional value. This is the additional value.
So minus the 158, am I right?
Right. This is the additional value and your 11 marks.
Two mistakes I did. So
It's okay. It's okay. It's okay. There's a
I
step
included the
always.
synergy
There is a
earlier.
step marking
And also, yeah.
in our ACC exam. So
But
you don't have
without
to
growth,
worry
I
that
took
much.
the annuity, that thing, no, terminal value. So those two mistakes.
Now the last part, practical part. The third part, I think that one is the most important part in which most of the student made mistake, which is impact on shareholder wealth. And it's a common question where examiner want you to, even in the past, they have asked this. So I don't know why students are not practicing past question and repeating same mistake, but it's important. Assumption question, assumptions are repetitive. Shareholder wealth impact, all these things are repetitive in nature. So do practice similar question. That's why I'm solving these question with you. So, sir, how to tackle this part? Obviously, you have to know to impact wealth of Joshua company shareholder before and after, wealth of Fraser company before and after, and you are done. Wealth before, wealth after, and you can easily understand that this is a positive impact. There is a positive impact on the wealth, or there is a negative impact on the wealth. Right? So let's see. What was the shareholding? Share before acquisition. Both company, Joshua. I may be writing wrong spelling, but it's okay. Fraser. Joshua, 40 and 10. 40 and 10. So 40 and 10 shares were before acquisition. Do you agree, all of you?
Yes.
But now This will not be the case.
Three shares of Joshua or one share of Fraser.
Shares after acquisition you have to calculate. Joshua shareholder will still have 40, but now Fraser shares will have the exchange issue was on
And 3 shares of Fraser to 1 share of 3 shares of Joshua, sir. So 30 million.
where it is given,
One.
from where you are.
It's your below. You have to go down the thing. There's a share exchange. Go down the thing. Yeah. Share for share exchange. In that, if you read, you will
At the
know that.
CEO
Yeah.
proposal, share for share will involve a Fraser company share being exchanged for 3 Joshua. So 3 Joshua shares. So how many shares we are giving? Our
30 million, because 10 million into 3.
for their 1 share we are giving our 3 shares. For their 1 share we are giving our 3 shares. So this equal to this multiply 3, our 3 divide by 1. Do remember this, divide by 1. 30 million. Now share after acquisition is 30 million, all of you. Please understand this. So total number of shares is obviously 70 million of combined company. 70 million is the total share here. Previously 40 million and 10 million were the share. Now the new entity has total 70 million share. Joshua company has given their own share to the Fraser company, and Fraser company shares are gone. Previously Fraser company 10 shareholders now hold 30 shares. So what is the difference? 10 million share of Fraser, now they have 30 million share of Joshua. Remember, the shareholder of Frasers previously have 10 million shares of Fraser, now have 30 million. So from where I got to know? From this pair. And they see one more thing. Based on the last year negotiation, the board believes it has good understanding of Fraser expectation. You have therefore been asked to incorporate minimum acquisition premium of 35%. So 35% is the premium they are asking, which is same as the premium requested last year. Or although this 35% they were asking last year, this you can write in the discussion part that they may be asking more for this year. 35% was the last year, and they are still considering the same 35% premium for this year. Let's see how much we are paying. We have also paying certain synergy. Let's see how much percentage is that. Is it more than 35% or not? Fraser company founder and majority shareholder unlikely to approve acquisition offer on terms which would lead to reduction in annual dividend. Okay, annual dividend they also don't want to get reduced. They want same annual dividend of previous year. However, Joshua debt includes a convent restricting dividend, and they can pay how much maximum we can pay? 25% of free cash flow. So we can only pay 25% of free cash flow. Let's see. The board has therefore asked for evaluation of impact on proposed term of next year forecast post acquisition dividend for both company shareholders. Very interesting question. Post acquisition. So you can calculate post acquisition value, post acquisition equity value for both. How will you calculate post acquisition equity value? You have total value. You can calculate value per share. What was the total value of equity? You got 180. This was your value of equity. You can do one thing, calculate value per share here. Total shares of new companies, this is value per share. Just multiply this, multiply this, multiply this. Getting my point? 180.66 multiplied 180.6566 multiply divide 70. It give you value per share. Then multiply by 40 and multiply 30. Let's also add one thing here. We have not calculated pre-acquisition equity value, because pre-acquisition equity value is also given in the question. Only then you can calculate change in a pre-acquisition equity value. So let me give the reference from above. For pre-acquisition equity value, it was this. Control C. 56. So pre-acquisition equity value is this. Now you can calculate percentage change. So how will you calculate percentage change, everyone? Is there a positive
Find the difference and
positive percentage change or a negative percentage change? Let's see. So this minus this divide divide by this. So how much is this? Wait a second. So let's convert it in percentage. Negligible 1.21 percentage. Okay. Let's talk about other firm. About the change in this firm. Under firm. Let's talk about other change. This one. 1 minute, all of you.
Sir, the question is asking
Hmm.
based on dividend, I think. It's not based on the market value.
No,
There is if you read
that is yes, I have read the question. So right on that part, you are right, Anuradhaji. The dividend impact they are asking, but both they are asking. They are asking total wealth
okay,
impact.
it says because there's a covenant of 25% on the thing. We have to take from the free cash flow, it is saying. So we have to see how far it is.
Yeah,
helping
yeah.
them.
Right. You are right. Correct.
Both ways it is advantageous to the appraiser company.
Wait a minute. Let me complete. See, everyone. This is the percentage we got 1.21% and 38%. Around 38%. So I can say yes. We are beating the minimum threshold. We can even write here.
35% is what they want. Premium, more than that.
Yeah. That is what I was saying. No, both we need to calculate. Acquisition.
I got a 36%. Somewhere
Premium.
I made a mistake. No, earlier so.
Acquisition premium of 38.26%. Acquisition premium of 38.26% exceeds appraiser company minimum threshold of 35%. So one positive thing, although the 35% is the talk of the past year, but let's assuming they ask for the same this year. Now let's also talk about the dividend. What was pre-acquisition dividend? Before acquisition dividend was 2.7. 2.7 and 3.2. 2.7 and 3.2. Very good. So pre-acquisition dividend is 2 acquisition. Now we have to see that what will the post-acquisition dividend. Now question says that 25% we will able to pay 25% of free cash flow. 25% of free cash flow. If you read the question, they have clearly mentioned the maximum they can pay 25% of free cash flow. So what is our year one cash flow? 19.6. So for this we can calculate
7.2. 7.2.
Maximum dividend which we can pay in year one is basically
7.2.
19.6 into 0.25.
Yeah, 7.2.
Right. 19.6. What missed? Okay, 4.9. Right. So it's 4.9 and
I got 7.2. 1 second, sir. Let me check.
And dividend. No, calculation is fine.
Okay, 4.9. Yes.
The dividend per share.
4.9.
There's nothing to check. Dividend per share is
0.07.
0.07 will be dividend per share. So
Yes.
Post acquisition dividend, how much dividend they will get according to their shareholding they will get now, because 4.9 is the maximum we can pay. So number of shares they hold, post acquisition shares they have 40, and on per share we are paying 0.07, they will get 2.8. Post acquisition share 30, and they will get 0.07. So here comes a problem, because percentage change, you can see just from the numbers that for acquiring target company, shareholder will not be happy with this percentage. Sorry, target company, this minus old divide by old, convert in percentage. So 3.7%, still good for negative 34.38%. Negative 34.38%, highly negative. Highly negative. No worries. For practical part, we are done. So this is all your practical discussion for 5, 11, and 6 marks. I hope you are able to understand that how easy it is. It's a last year question. Although some points you may mistake, but I don't think you will lose entire marks in this area. Not that much difficult. 5, 11, and 6. So it's around 21, 22 marks you are getting only on the practical part, and the theory part is also not that much difficult. If you talk about the fourth one, advise board of any concern, either company shareholder may have acquisition, discuss the validity of assumption in evaluating. So you know that assumption part is very common. Examiner frequently ask assumption part, even shareholder concern. And the fifth part is the common sense part. You can write about buyback, positives of buyback. Obviously, if you are going to buy back, there will be less liquidity. It will protect from takeover, but buyback will also improve your EPS. Buyback, but for doing buyback, you need fund. You need money to do buyback. So all these things we can write here. Let's see. First, in the fourth part, they talk about shareholder concern. After this, let's read the examiner answer in relation to shareholder concern. Always remember, answer everything they have asked. I have seen student doing this mistake, that they answer some part of the examiner question and they don't answer some part of the examiner question. That is where you generally lose marks, all of you. If you are not answering everything examiner asks, so this is only the part where which we are discussing about. This part only discuss about shareholder concern. Assumption part we will write separately. However, concern part also examiner written very long. It is this much is not expected in exam condition. For example, if I the assumption part, I will give you summary which you for assumption part. Let me give you one summary. Assumption. This you can write for assumption part. Okay, do one thing. First read shareholder concern, then we will discuss. I'm giving 2-3 minutes to all of you. Give it read fast. Done with reading, all of you? आया कुछ समझ?
Yes, sir. Read it.
Can we write in our own words some of the points we can make in our exam? For example, they are saying Joshua Company proposal to acquire Fred was previously rejected on the ground that if we fail to create value for Joshua Company shareholder, both company shareholder likely to be concerned about credibility of revised calculation since very little time has passed from when last decision was made. Obviously, very practical. See, all these things you cannot write from your cram knowledge. It's require a real time visualization and application of scenario. The board will need to communicate what has changed between now and then to justify the sudden improvement to the shareholder wealth estimate. In addition, Joshua Company share of additional value is positive, but only small margin. You can see Joshua Company. So all your calculation should form part in your answer. Just what you have done in the calculation, write in words. Write about Fraser Company concern that they are not meeting dividend capacity. The share for share exchange is again very dangerous in relation to cash, because when they are agree to get share, they are again facing the risk of Joshua Company. Instead of Fraser, now they have Joshua Company share and who is already struggling in the market. So why they want to take the share of a company who is already facing so much fears of takeover, shareholder negativities going on with that company? And even the dividend is decreasing. Currently, they are getting very high, more dividend compared to the dividend in Joshua Company. All these things you can write. Then for assumption, simply assumption what? Check, estimate, make sure number used for calculation like company value, growth rate. Obviously, in assumption, first thing is your estimates. They are subject to change, so you will always assume that they are realistic. Consider capital changes, be realistic about growth. They have assumed a growth, forever growth of 3%. You can question about that growth. You can suggest some sensitivity analysis, scenario planning, some these things in the assumption. So assumption question are constantly part of the exam, and this is a summarized assumption. You can read detailed examiner answer also, but ultimately these are the points which you have to write here and there. About estimates, about growth, about capital structure, about timing. Recognize that it may take finalize the acquisition despite assuming an immediate purchase. Obviously, acquisition will take some time. Are you recognizing the time value of money? Are you forecasting your? Have you verified your forecast or not? So forecast verification, estimate checking, changes in capital structure, growth rate, realistic is not. All these things need to be written in your assumption answer. And finally, last part, they want us to want us to write. Let's see what they want in the last part. Discuss the credibility of CEO alternative session of share buyback. Advise whether it is feasible for strategy. So this part also you can deal very easily. Let me show you the examiner answer for this part also. And in the report, all this will form part of report, all of you. And in the report, always remember, always remember to write conclusion. So read this part, all of you, fast. Read fast. So done with this, all of you. So all these things are a general discussion they have done कि buyback के क्या benefit हैं, buyback का क्या नुकसान है. Obviously कंपनी अपने पास शेयर रखेगी तो मार्केट में शेयर नहीं होंगे, बायबैक करना मुश्किल होगा. but the money, from where money will come, and ultimately in the last you have to write about the conclusion. Finally आप क्या लिखते हो कि the acquisition appeared to be at minimal financial value to Joshua shareholder and exceed the premium requested by Fraser Company shareholder during the last round of negotiation. However, as stated above, Fraser Company shareholder may raise their expectation about the appropriate premium this time round. In addition, Fraser Company will still may not approve the offer because possible reduction in the next year dividend. Both companies are likely to have concern about credibility of new privilege, including the strategic rationale underlying acquisition, and these issues will need to be addressed. So ultimately, बच्चों, ये जो यहाँ पे बातें लिखी हुई है ना, ये इन्होंने समराइज करके कंक्लूजन में कोई फिक्स आंसर नहीं दिया है, वही सारी बातों की समरी दी हुई है. कंक्लूजन को आप ऐसा समझो कि जो सारी बातों की एक तरीके से समरी है. तो इसको इसको प्रैक्टिस करना, एग्जामिनर के आंसर्स को रीड करो पूरा. आपको ऑब्वियसली यू डोंट हैव टू राइट एवरीथिंग in the what examiner is written, but you should have some pointers similar to these, and by reading these answer you develop these pointers, right? Okay, so let's wind up our discussion on this question. Take care all of you. Bye bye.